than the average price over the purchase period. Sound good? Let me show you how it's done. You start by deciding how much you can invest each period. Let's say it's $100 a month. In January, you invest $100. With a share price of 20, you buy 5 shares. In February, the share price has fallen to $10 per share, so you get 10 shares for your $100. By March, the price is up to $25 per share, so you only get 4 shares. If you do the arithmetic, you'll see that the average share price over the period is $18.33, but you only paid an average of $15.79 per share. Sounds good, doesn't it? By investing the same amount every period, the math guarantees that you'll pay an average price per share that's less than the average price over the period. This makes my spider sense tingle. This is too easy, too good to be true. What's going on? If January's price is fair, and February's price is fair, and March's price is fair, then how can getting 3 fair prices turn out to be better than fair? How can it be a good deal? That can't make sense. The problem is that the average price per share purchased and the average price over the period are 2 different types of averages. The average price over the investment period is an equally weighted average. We count January the same as February and March. The average price per share purchased, though, is a share-weighted average. In our example, February's 10 shares count twice as much as January's 5 shares. Both of these averages can make sense because they're telling different stories. But it also makes sense for someone to say that his word is worth its weight in gold. That sounds wonderful too, until you think about how much his words weigh. Although I don't think dollar cost averaging delivers what it promises, I do think it has some appeal. If you dollar cost average, then you invest on a consistent, ongoing basis. That's good. Dollar cost averaging may lead to good outcomes, just not for the reason most people think. Many of you have heard purported experts saying that the market did this or that because of something called market psychology. I'm not a fan of that explanation because it doesn't teach me anything. If the market goes up and people don't know why, then they just say it was psychology. If the market goes down and they don't know why, then they say the same thing. Who needs experts like that? What's missing from the market psychology explanation is investing advice. The efficient market hypothesis teaches me to minimize transactions costs because I can't beat the market consistently. Portfolio theory, as we learned in Lecture 5, teaches me to diversify. What I need from the psychology story is some advice that I can actually use. In the last couple of decades, the field of behavioral finance has evolved to the point of being able to do that, or at least to come close to being able to do that. The idea behind behavioral finance is that people's emotions affect prices. Of course, everybody agrees that emotions do affect people's decisions. For behavioral finance to make a difference in the price of stocks, though, we also have to assume that the sharp guys, the ones who have lots of data, technology, skill, and time to spend on stock analysis, are restricted in the amount of trading they can do. The reason those restrictions matter is that if the clever traders are unfettered, then competition will protect the emotional traders. Suppose that Amazon is trading at $400 per share before a bit of bad news comes out. Now it's only worth $390 per share. Suppose I make a bad mistake, and I think it's only worth $300 instead of $390. Because of that mistake, I want to sell now as fast as I can before Amazon falls to $300. I'm so scared that I'll sell at any price I can get over $300. Now, you and Margie are clever and know better. You know Amazon is worth $390. You'd be happy to buy at $300 from